We're going to calculate the stock price for Blackrock. First thing we need is the market cap, which is 80.16 billion. And then the stock price, 528.64. Now we can figure out the shares outstanding, which is just the market cap divided by the stock price, 152 million shares outstanding. Next is free cash flow. And free cash flow is the best way to calculate the stock price for a company. You just estimate future free cash flows and discount back to today's dollars. So we can find this in Yahoo. And we're going to get 4 years of free cash flow. And then net income. Which is, and last is revenue. So the numbers look pretty consistent. Revenue rising. So it looks pretty good so far. Next, we need to look at the capital structure of Blackrock and figure out the discount rate we need to apply to future cash flows. So the interest expense is $203 million. That's the interest Blackrock pays on its debt. Let's find the debt in the balance sheet. Go to liabilities, current liabilities, no current debt. There's $5 billion of long-term debt. And interest payments on debt are tax deductible. So let's find the effective tax rate. So the income before tax, 5.8 billion, and the income tax, 1.3 billion. So the effective tax rate is 22%. So the cost of debt is 3.2%, and they only have 6% of debt in the capital structure, which is pretty good. Next, we need to figure out the cost of equity, and we need the beta, which is 1.29. That's the volatility of the stock, and we use the capital asset pricing model to come up with beta, and that's for this 12.23%. And as you can see, equity is more expensive than debt because equity sits lower in the capital structure of a company. In the event of a default, debt holders are paid before equity holders. Now this is the weighted average cost of capital, 11.7%, and that's the blend of cost of equity and cost of debt. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future cash flows. We also estimate a terminal value, which is all years beyond 4. And we used a dividend discount model or Gordon growth model to figure this out. And then we present value these numbers back to today. And the value of Blackrock is $43 billion divided by 152 million shares. So we calculate a stock price of $281. And it's trading at 529, so it's trading at an 88% premium. So this, according to the model, is a sell. And it looks like it wasn't even trading at 280 for many years. So it's been trading at a premium for a while. And this is pretty common that I'm noticing with big companies, that people are paying more than they're worth in the hopes that the future of the company is better than the present. It could be a good investment, but as you know, the stock price is irrelevant to the value of the company. It's based on what investors are willing to pay. So if more people are buying a stock, it's going to get driven up the price, and if more people are selling stock, the stock will get driven down until the price point is matched between a buyer and seller. Now, if you ever do some research, you'll find some analysts saying, BlackRock's a buy. You'll find other analysts saying Blackrock's a sell, but each analyst uses their own model and their own assumptions, but you never actually see their model. This is my model, and it's my opinion, and thanks for watching.